Hello everybody and welcome to this video on understanding different aspects of corporate actions. I'm your learning partner Sushila Hariharan, and if you're interested in a career in fund accounting, corporate actions, trade life cycle and OTC derivatives, I urge you to subscribe to my YouTube channel. Let's revisit my topic of the year, which is corporate actions, and I'll tell you why I love corporate actions, because it's so important not just from the point of view of hedge fund and as well as custody operations. It's also important from the point of view of investment banking operations. So let's understand what are the different types of corporate actions. Let's classify them. Let's understand important dates and so on and so forth. In this video, I'm your learning partner Sushila Hariharan. If you're interested in a career in fund accounting, corporate actions, trade life cycle, OTC derivatives, do subscribe to my YouTube channel, where we provide content centric and research focused videos on these topics. We will be covering these four subtopics within the topic of corporate actions, understanding what are corporate actions. The second one is types of corporate actions. The third is the role of participants. And fourth, of course, dates. Without dates, what are we, right? Corporate actions. Corporate actions involve multiple entities, including depositories, custodians, transfer agents, etc. And there are some other aspects of corporate actions that we will be looking at. First one, there has to be a material change. Okay, this is defined by many resources as corporate actions is a material change which impacts the securities owners. Over here, we have to clearly identify that the material change has to be significant, which is impacting the owners of the securities. These securities owners are equity holders, and when I mean equity holders, it could be the different class of equities, class A, class B, class C, etc. It could also mean preference shareholders, especially those who are holding redeemable preference shares, convertible preference shares, etc. And also includes bondholders. The different types of bonds issued by the company could include convertible bonds, it could include foreign currency bonds, it could include foreign currency convertible bonds, and so on and so forth. So securities owners include equity holders and bond holders, and if they get impacted by the change, then it is known as a corporate action. Okay. The two types of corporate action are mandatory corporate actions and voluntary corporate actions. Mandatory corporate actions, over here, see, it doesn't stand for chartered accountants, it stands for corporate actions. Mandatory corporate action involves zero additional effort by the investor. The issuer announces the corporate action, the investor has to participate in it. Okay, there is no choice given to the investor whether you want to participate in it or not, and hence it's mandatory from the investor point of view. For example, if a company announces dividends, then the same rate of dividend is applicable for all shareholders who hold the same class of shares. Okay, an investor cannot say, no, I don't want dividends this year. You accumulate my dividends and pay me next year. Okay. So if the company has announced a dividend on its equity shares, then all the shareholders will get the dividends, irrespective of whether they want to receive it or not receive it. All right. So mandatory corporate actions mean that the investor participation is mandatory. In voluntary corporate action, the investors' participation is not mandatory, and they can choose whether to participate in the corporate action or not. This is an example would include rights issue. A rights issue is an issue where investors are allotted shares at a certain ratio, and these shares are at a price which is at a discount to the prevailing market price, and investors can then choose whether to participate in the rights issue or not. The participants in corporate actions are, of course, the following. The first one is definitely the issuer that has issued the securities, that is the equity instruments, the bonds, the debt securities, the preference shares, the DVRs, etc. The second entity that is very important is the transfer agent. The transfer agent is responsible for transferring the securities into the owner's name. The third entity is, of course, the investor. The investor is the one who is holding the securities and will get impacted because of the corporate actions. The fourth is a custodian. The custodian acts on behalf of the investor and therefore is responsible for encashing all the corporate actions. Let's see in detail the role of the transfer agent. The transfer agent acts on behalf of the issuer of the company. So every day there are millions of dollars of securities traded on the securities exchanges like NYSE, NSE, BSE, and so on. The transfer agent ensures that the seller's name is deleted from the list of owners and adds the name of the buyer. Okay, so this is a very important aspect of transfer agent. They record the securities ownership. They transfer from the seller to the buyer, and this is done on a daily basis. Okay, so different markets have different settlement cycles. Some could be T+1, some could be still T+2, and given the settlement cycle of these different agencies, of these different markets, the transfer agent records the securities ownership. The transfer agent is responsible for transferring the securities from the seller to the buyer so that all future entitlements that are announced on the securities are then given to the buyer. The transfer agent who acts on behalf of the issuer calculates the holdings of every investor, then calculates the entitlement of each investor, and is responsible for payment of corporate action entitlements. Okay, the transfer agency role is never to be undermined in this whole cycle. People keep saying, oh, it's almost always automated, etc. But automation is great, but if you don't know and don't understand, then how is automation going to help you in building a good case? So transfer agent is responsible for transferring securities and therefore calculating the corporate action entitlements. Let's say KH Inc. announces a corporate action. The transfer agent who is appointed by KH Inc. calculates and pays the entitlement per holder. Is this clear? So the transfer agent acts on behalf of the issuer. On the other hand, we have the custodian bank. The custodian bank possesses the client's investment portfolio. Investors like hedge funds, mutual funds, hedge funds, mutual funds, retirement funds hold trillions of dollars worth of securities. And the custodian bank, therefore, is appointed by these asset management companies to manage their portfolio, not to trade in their portfolio, but to manage the settlement of these trades that take place in their portfolio. The custodian bank, thus, is in custody of the client's portfolio. So the portfolio is owned by the asset management company, but it is held by the custodian bank. It is responsible for clearing the securities at the time of payments. Okay, so whenever trades are getting done on the securities exchange, the custodian bank does the clearing, that is the pay in of the securities into the depository. The custodian bank is thus responsible for corporate action entitlements. These entitlements are very important. So while the transfer agent is responsible for calculation of the entitlements and distribution of the entitlements, the custodian bank is responsible for corporate action entitlement receipts. Okay, so the custodian bank thus is a very important aspect of this trading cycle. Harry Hedge Fund, for example, owns the investments. Custodian possesses the hedge fund's investments. Okay, so we saw how the transfer agent acts on behalf of the issuer. Over here we can see how the custodian is acting on behalf of the investor. The last important topic in the case of corporate actions, of course there are multiple topics including the process flow, etc. The most important aspect of corporate actions is understanding the record date. The record date is the cutoff date on which the transfer agent records the list of holders of securities. At the end of the record date, the transfer agent calculates the corporate action entitlements. The X date then is the date on which from which the securities will be traded in the markets without the entitlement. So in earlier days, it used to be a fun activity to do to calculate the X date from the record date. But nowadays in most markets which are running on a T+1 cycle, the record date of the X date are mostly the same. So the market is trading on a T+1 stock exchange date. The record date is normally the X date. Or the other way around, the X date is normally the record date. If on the other hand it is trading in T+2, then the record date comes first and then the X date comes on the next day. Thank you so much for watching this content. If you like it, do subscribe to my channel and tell your friends who are looking to make a career in investment banking that they should watch this content. Thank you.